Hey everybody, Ian Miller here from MCT. Thanks for joining us today. We're excited to get started, but we're just going to give a few more minutes for everybody to get in the room here. So I'll kick things back off in about 2 or 3 minutes. Thanks for your patience. All right, everybody. Once again, welcome to our MCT webinar today, The Power of Bid Tape AOT. My name is Ian Miller. I'm the CMO here at MCT, and I'm just here to get things set for all of us here and introduce you to our presenters for today. So, as with all of our webinars, please use the questions function to submit questions as we go along. Phil and Greg will be able to see those questions and I'll address them as they go through, but we'll also be having a Q&A section at the end. We're going to do our best today to come a little bit closer to our scheduled time and leave some room for those questions. With that, speaking today, we've got Phil Rasori, the COO here at MCT, and Greg Vacura, SVP of Correspondent Pricing at Wells Fargo. You may know Phil and Greg from their previous appearances together at national and regional conferences or at MCT Exchange. But in between those public appearances, Phil and Greg have done a lot of great work behind the scenes to make the loan sale process smoother and more successful for mutual clients. One of those ways they've been working together that they've spent a lot of time on is the focus of our webinar today, Bid Tape AOT executions. These executions have been one of the more groundbreaking innovations in the secondary market in several years and have led to significant savings and risk mitigation benefits for MCT clients. Today, Phil and Greg are going to share a refresher on the economics and the process of Bid Tape AOT, some context on how those relate to current events and next steps for you to take advantage. So I'll turn it over to Phil.
Well, thank you, Ian. We'll go ahead and get started with just kind of as Ian said, some of the current events that make the Bid Tape AOT, extremely useful in this environment, and then Greg will go through kind of just for basics for those of you on the call that don't understand the AOT in general versus bit tape AOT and the kind of legacy AOTs of the past. No person better than Greg, who created some of these programs to go through that with you guys. But basically, the reason for the call, obvious to a lot of you guys, we obviously coming off of March and April, where there was significant cash exposure at the broker-dealer level. And then now, as rates continue to, obviously a very good thing, rates continue to drop, pipelines continue to explode, it becomes a more and more capital intensive, cash intensive business to really keep as a going concern. And obviously that happens in any rally. This current rally is a little bit unique in the land of TBA trading. And basically what's happened is you have a little bit of a perfect storm, if you will, on the TBA trading side. You have record volumes. There's been, for those of you who experienced this in March and April, especially the last week of March, as the Fed drove those trades out of the money, driving those TBA pricing through the roof. That created a lot of capitalization issues. Broker dealers had increased requirements. Their credit departments obviously, had major concerns as to whether or not they were going to get paid on these settlements, primarily in April, but also May. April turned out to be April and May really for the most part turned out to be a win. We really didn't have it was very, very few defaults, I think, in the industry as a whole. I know we've talked about this before. They got a little bit of bailout there, I think. Broker dealers did, lenders as well, from the PPP loans, which got funded right before Class A settlement in April. But bottom line, credit departments are still concerned, have definitely contracted lines. You've had broker dealers, like I said, contract lines line sizes that they normally give. And then you've also had broker dealers completely exit the space. So at the end of the day, the bottom line is you've got a supply and demand issue. There is far more demand for trading lines than there is supply. And look, you can't fault the dealers. This is, and we're not saying that anyone is egregiously gouging their clients. However, just to be clear, anyone that tells you that their execution today is the same as it was 6 months ago in the TBA space is lying to you. That's the bottom line. The TBA execution across the board has suffered because of the fact that there is such a demand for TBA trading lines versus what's available out there. So obviously, for those of you that know what a AOT is, that obviously is makes AOTs substantially more valuable, and attractive as bid offer spreads begin to widen out because of either market forces or, in this case, just supply and demand and broker dealer markup or markdowns. So for those of you that don't know what an AOT is, I'm going to pass it over to Greg, and he can give a quick overview and then also go into kind of the history as in how Wells really pioneered this new bid tape AOT execution, which I know I've been a broken record on this over the last couple of years, but we truly think it is the biggest thing to really the biggest innovation in secondary and execution at the aggregator level in the last 20 years. So it's a big thing. So with that, Greg, if you want to take it away.
All right, thanks, Phil. Yeah, just quick refresher on AOTs to begin with. We've been doing AOTs for 20 plus years, and kind of our normal, old school legacy mandatory was assignment of trades and TBA bulks, and we've done a lot of those, and they had their place. They still have their place to a degree, but certainly bid tape has come into the mainstream forefront of being the number one mandatory type of takeout. But the AOT side is definitely unique in that, as a client, you can assign your trade right to us. Now, the old program that we currently still have, but kind of the old rules of the program were really that you traded your assignment of trade, you sent it over to us, and it was a single coupon, X dollars within it. It was definitely some maintenance, I won't say issues, but there was maintenance items to deal with that trade, but still a very good execution option, an efficient execution option at times, and what we really got into seeing was the history of AOTs has really declined over the last 4 or 5 years, and bid tape's really taken off. So we definitely see that bid tape has gone from, in June of 2015, I was looking back, 1% of our production was bid tape through mandatory. A year later, it jumped to 35%, then 50%, and bring it forward now into October of last year, we were at 90% bid tape. But we did see a unique item come up in March again, where we all of a sudden had a big push of AOTs again, basically to what Phil was talking about. When our clients had some trades that were already assigned or that were already in their position, and when they went to unload that trade with their dealer and then take down the new position through bid tape with the aggregators, they lost execution, and that settlement process, the bid offer process there, they lost significant execution for a window. And we also were seeing some serious execution issues on just our normal trading activity, where we really couldn't trust the screens. We had, it was kind of funny where we get production through the day, then we take our hedge positions down as we go, very similar to the way most of our clients work that are hedging their production, and we'd stack up some production, and an hour later go to take a position, and the screens were saying, price of 101 and pricing was par 5. And so we were really struggling with where to set our daily marks and to set our intraday changes as we went through the day. But a really nice feature of assignment of trades was that trade price and position was already set. So simply assign it over to us, and we don't have to deal with this market issue that was happening in March, April. Now, since then, yes, some of that position has faded back away, and it's been a little more consistent. And then now we've seen more of the AOTs that went back to the traditional legacy AOT transfer back into bid tape AOT. So it definitely was something to have an option for clients to still have that AOT available, and when needed, certainly use it. A couple of the negatives, as we talked about on the old program, was 50% of the collateral had to be in our shop for us to accept that AOT. So there were some timing issues there. With the new bid tape AOT, we accept those AOTs the day of trade. History has shown that our bid tapes come through so fast, from time to bid to the time that loan shows up. It's really averaged about 2-3 days. So we're very comfortable taking that trade. The loans are closed. The positions are easily transferred over to the aggregator. So we're fine accepting that trade and that AOT day of, and whereas versus old school, it had to be usually it was a 1 to 2 week window as those loans got delivered. So
and
that's
Greg,
been a very good benefit there. Go ahead, Phil.
I was just going to say, if I can just add in that, as an outsider to, that program that you got when you guys created that ability to take the immediate acceptance, that was a game changer for all the lenders, on the line, because there was, throughout the days of the initial QE rallies of late 2008, early 2009, all the way through QE, we would have clients come to us saying, okay, we want to, we can't make these margin calls. We want to assign trades. The problem is, of course, they had to wait till those loans hit the doorstep. Wells being 50% was actually more lenient than other investors out there. But the bottom line is the ability to immediately accept that AOT and immediately take that exposure off of the line was essential, and really a game changer, and especially valuable for our customers in March, when those trades and when they were being called for these ridiculous margins.
Yeah, and that was a big issue, definitely a big issue for a lot of clients. So yeah, thanks for that additional color. And real quick, I'll just get into a few more of the benefits of the bid tape AOT, then I'll throw it back over to Phil for some more of the slides he has to go through. A big benefit of bid tape AOT is also the way we manage the volume coming in. On the traditional AOT, it's really got to be coupon. It's very coupon sensitive, where the loans have to qualify identical for the coupons that come in. On the bid tape side, bid tape AOT, hybrid AOT as we call it on our desk, there's a lot of flexibility. As long as you have one loan that will meet a coupon. So if you have most of your production is in the 2.5 coupon, or most of your hedge position is the 2.5 coupon, and then there becomes a shift in the market, we are good taking loans out of different coupons. You can assign us your main hedge position coupon of a 2.5, but you can fill it with 2s, 3 coupons, and we're good with that. So it's definitely got some flexibilities that standard AOT doesn't have. And Phil will get into somehow that the math of that all works, but that's definitely been a big maintenance ease issue to help our clients in their positions, being able to trade out of their position easy and not worry as coupons shift. As you start seeing more loans come in and lower coupons, you don't have to worry about doing a bid offer on a loan that you already have just because it's in a different coupon. We'll take that through the program for you. Maybe I'll throw it back to you, Phil, if you have some other highlights to add, and then take it from here.
Yeah, I think that the ability to combine trades and like Greg was saying, the coupon transition in a coupon transitioning environment like we're in right now, is definitely essential. I mean, we again, just some of the benefits of these new programs, again, pioneered by Wells, the ability to combine small trades against a volume. In the past, we were, for smaller customers, we were holding, basically letting new loans come in, trying to get larger trades, so that we could assign positions within the tolerances. Obviously, the tolerances are now gone, and the ability to combine positions and cross coupon assignments are really another big benefit to the bid tape AOT. So just going into best execution strategy, and Greg will definitely, if you want, cut in here at any time. But basically, what obviously you're looking to do there's two components to to AOT benefits. Number one is execution in a normal environment. That's all we really care about, obviously. In a substantially, very volatile environment, cash becomes an issue, and so cash might overtake execution, and we'll talk about that in a second. But in a normal environment, we're looking at basically taking the benefit of the AOT, and that is basically the offer side that you are erasing from the pair off. Basically, you're not getting rid, obviously, of your bid cost when you go and sell the position, but you're getting rid of the market offer spread and the dealer spread. And so again, you're going to want to apply that savings to the corresponding commitment, but to be clear, you don't have to, because Wells and other programs allow you to over assign, meaning that you can assign $1 million trade against a 600,000 loans. You're going to want to take the total savings of that $1 million assignment and distribute it across the loans. Now, when you in practice on the best execution analysis, obviously you're not going to you're going to want your commitment prices to match up. So you're going to order your best X by your savings, but you're not going to obviously change your pricing, your net sell pricing, because that's going to obviously cause issues down the road when you analyze secondary variance reports of your commitment price versus your purchase price. With regards to so it's kind of the same functionality that we have when we incorporate file fees into the best execution analysis, like a $500 file fee on a $100,000 loan is a 50 basis point hit. We don't actually take that out of the price, but we use it to adjust. Maybe there's another investor with a $250 file fee. We use it for the ordering of the best X, if that makes sense. So we're gonna think of the total bid offer savings created by the AOT, and then we're gonna apply it accordingly. So what I mean by that is, if you think of a scenario, and this is actually a scenario when actually Wells initially came out with this program in summer of 2018, we did this is a slide from there. You can see we were at a 4 coupon back then, and basically where you are in a situation where you're assigning $1 million onto $750,000 in loans. The bid offer savings that you're in an example where you're saving, in this case, 6.25 basis points, that's 2/30 seconds. And just to step back to dealer execution right now, if you think of a half 30-second to 1/32 of the market that you see on TradeWeb, it's very, very possible that you're at least at 6.25 in total, 2/30 seconds in total execution that you'd be saving on an AOT. So in this analysis here, we've got 750,000 in loans, and you see what we're basically doing is we're saying that the assignment ratio, we're assigning 133% the value of the loans. And so basically the savings for that value of loans is going to be 8.3 basis points, because you need those loans to actually get the assignment to take place, right? So again, using this example up here, if let's say Wells Fargo was at 104 on a given loan, and there was another investor at 104 spot 04, in this example, using that highlighted, if you can see that highlighted 2.5 coupon there, we are saying that there's a 4.7 basis point savings. So what's going to happen is, even though Wells Fargo is actually behind by 4 basis points, it's going to, the best X is actually going to show Wells Fargo as the best X. And again, I'm using 4.7 basis points as a normal execution right now. It's definitely going to be higher. So you can see that it goes to, when you talk about assigning over the loan amount, you can actually increase the savings upwards of at these current bid offer spreads that we're seeing, upwards of an eighth of a point. So Greg had focused on this, on cross coupon AOTs. This is really really important right now, as we're all seeing this transition, from threes. If you look at this graph here, the green is the Fannie 3 coupon, or the UM 33, and the red is the 2. The black is the 2.5. And so you see, if you look at this, as you guys know, for those of you that are trading TBAs, the market was initially very hesitant to trade a substantial amount of 2s. And that has really, these are for June securities now. That's June settlements. If you were to look at July and August, the red's going to definitely probably eclipse the black. So you can see that definitely we're transitioning in coupons here. When that happens, you have generally, for those of you that are recycling trade positions, again, trying to reduce your bid offer spread cost that's associated with, with TBA trading, you're going to have older trade positions versus your newer loans that are locked in a lower coupon environment. So you're going to have 2s against 2.5s. The advantage of, again, that Greg referred to that is unique to Wells Fargo is the ability to cross coupons, basically, as long as you have a loan in the given coupon. So this is an example of a 2.5, and then there was actually 3 and even 3.5s in the UM30. We were able to combine all of those, and this is actually a loan sale from yesterday. We were able to combine all of those against a single assignment of a UM30 2.5. So you can see that the ability to, in the past, that would not have worked. In the past, you would have had to have had corresponding volumes and corresponding loans and trades in all of those coupons to make those assignments work. So you're able to basically get the benefit of the assignment without necessarily having trades in those corresponding coupons.
Which obviously was a pain to try to be able to have to do stuff with one coupon and then another, and if you're below our tolerances of 500,000, it just makes stuff cleaner and easier to be able to smush it all together, and we'll take the pile however it is comprised, and hopefully just to make life easier for the takeout and for the clients.
Yeah, it's definitely a game changer, because one of the I would say the knocks against trading for AOTs is that you always want to match the month to your lock term. Meaning, if we're locking a loan today that's going to close, let's say first week of August, we're going to sell a September, and we really can't sell. And let's say 2 weeks from now, we're going to still sell a September. You would never be in a position where you could sell. You could sell in October. In this case, because Greg's kind of program here, Wells's program allows you guys to cross coupon assign, you can sell a back month. Okay, so you can sell. So right now, if you have July, right now if you have July, August, September, a week from now when we cross into trading October, you would normally never trade that if you want to assign that position for a corresponding 30 to 45 day lock. Now you can trade that October security. You can recycle loans. So again, recycling loans through your hedge is, if we think of the normal hedge transaction as a loan coming into your pipeline, creating a long exposure, you offsetting that long exposure with a short position against that long exposure, and then hedging that loan down to funding, you selling that loan to, let's say, Wells Fargo, them giving you a price and a commitment, you've offlaid it. And then instead of pairing, normally you would pair out of that position, but then when we recycle, what we do is we use that loan sale as an effective hedge for new production coming into the pipeline. And the reason I'm focusing on recycling here when we talk about combining coupons is the drawback of recycling is in a scenario like we have here, where we've steadily drifted down in coupon, you can have situations where your trade positions may be in higher coupons than your new production. Obviously, if you get into you need to stay in liquid coupons that have positive duration, obviously, but this enables the ability to combine coupons and allow for the assignment to occur with one coupon in the trade but multiple coupons in the loan. Really is a game changer from a flexibility standpoint for the seller. Just going into cash management here, because we've had a lot of questions about this. As things have kind of we've had about 5 client calls of hey, what if things turn for the worse again, like they did in March. Obviously, I think we all have our opinions about that. I think it's very clear that the Fed, was a little bit, probably looking back on it, Monday morning quarterbacking March was probably late to the game. TBAs fell apart, and then they overshot. Then they came. So that created a lot of volatility that even in, God forbid, another a horrible breakdown, the Fed's probably not gonna repeat what they did in March. We would hope. So you're probably not gonna have the same. We would hope that we don't have the same volatility, but we get that question a lot. So from a standpoint of execution, obviously, dealer execution, and again, this is okay. How do I have the ability to assign at certain investors, again, from a volume standpoint, and we'll talk about who's accepting bid tape AOTs in a second. But from a volume standpoint, look, it's primarily Wells Fargo right now. And so obviously you have a lot of, you have, let's say Wells Fargo accounts for 30% of where you're selling your loans. There's obviously 70% of your production that is not going AOT, and is correspondingly going to have trades against it that you need to pair out. So so there's only a certain percentage of your hedge positions that you were able to assign. So we want to prioritize which ones to do that. So obviously, if we're only talking about execution in a perfect world where we don't have to worry about cash, it's going to be dealer execution. So that's your capital markets secondary marketing manager, or your MCT trader, or whoever manages your pipeline is going to be able to tell you which ones, obviously those with the better executions, you are not going to want to assign. You're going to let those, you're going to pair out at those with the worst executions. You're obviously going to AOT those. Now, margin policy really throws a wrench into that whole analysis, because in a month like March, where there was margin calls galore, certain dealers call it margin mania, it was that changed the analysis. So if you have a dealer that has a lenient margin policy or no margin, they don't call margin, and there's a couple of those that don't. Those you would want to leave those trades on, and you would want to roll those trades with that particular dealer. And obviously, the ones that have the more harsh margin requirements, you would want to assign those positions at those positions when you can. One little note here on margin is, for those that don't have, you want to get the most bang for your buck from a hedge standpoint. For when we're talking about cash preservation, cash management, you'd want to trade with the dealers with no margin requirements. You'd want those to have the highest possible durations, lowest wax, weighted average coupons possible, because that's gonna get you your as much hedge as much hedge duration as possible from those dealers, and hopefully requiring less from the dealers that are hitting you substantially with margin. Another thing to keep in mind is purchase versus settlement dates. This was really apparent in the last week of March. So a lot of people have come to know that as the Fed's week of terror, where the 23rd through the 30th is when the Fed really stepped on the gas and bid up TBA prices, obviously sending trades substantially out of the money. And during that, I use March 26th, the end of that kind of in that initial week there, as an example. During that, nobody really knew where things were going, and margin calls were coming in one after the other, and it was a pretty scary time for everyone. If we think about an AOT, though, so obviously your trades at this point, because a lot of you guys were bringing loans in, not just in February at this point, you're bringing loans in middle of March. And if you remember, middle of March, TBAs had fell apart. So the market was horrible. And, so you now had sold trade positions that were, literally 3, 4, and 5 points out of the money. So you're selling those positions. If you think about it in March, you're selling those generally for settling in May. Now there's this urgency, at least in the mindset of a secondary marketing manager, there's an urgency to get those positions off, to assign those positions, because there's this massive settlement that is bearing down on them in this case in 45 days. Now that's not necessarily a bad thing to assign that position if it's at a dealer that is calling you for a mark-to-market margin. But there are dealers who are not calling you, and maybe they have They either don't call margin a lot, or they have extremely large de minimis margin amounts that they're not calling you on. So those dealers, we do not want to assign that trade, because what you're doing, if you think about it, now there's obviously other issues with loans being purchased, and Greg can definitely tell you about that during end of March, where there was capacity issues. But from a standpoint of your, matching, you've got two cash flows that you're combining into one when you do an AOT. Normally you've got your loan purchase from the aggregator, and you've got your trade settlement at the broker dealer. You're now accelerating the settlement into the loan purchase. And in this case, that would be a very bad thing, because basically what you're doing, if you're tight on cash on March 26th, and let's say that aggregator bought that loan quickly, let's say they bought it in a week, first week of April, now you've got a situation where you have accelerated that cash exposure over a month into the first week of April instead of the second week of May. And so that's a mistake we see a lot from clients and just market participants that assign positions because they don't look good. But when you look at the cash exposure, if cash is an issue, that would be a position you definitely don't want to assign. Now, if you're getting called for margin, totally different story. If you're getting called for margin back to a zero mark to market, it doesn't really matter, and you're looking to you're obviously looking to assign that exposure off as soon as possible, based on what we talked about, or what Greg had talked about earlier, the fact that you're able to take that assignment. They're able to take that assignment and immediately send it to the dealer is obviously better than having to wait to settlement. But it's important to think about from a strategic standpoint of which positions you're going to assign. Obviously, again, all things being equal, and if you're concerned about your margin, immediate margin, then you would assign the absolute, the trades that are out of the money the most. But again, keep in mind about how you're accelerating that settlement and moving it into the purchase date. One of the things that's interesting about AOTs is obviously March was pretty unique. But if we take out March and we just look at the past 10 years before March and April, the majority of times that our clients actually ran into cash issues, again, these are smaller independent mortgage lenders, the majority of times was actually not in rallies. It was in significant market deteriorations. So that would have been, there was taper tantrum of 2013. There was first quarter of, let's see, what was that, 2019, 20? Yeah. So, those, when you had substantial, kind of quick market deteriorations where you're selling loans at substantial discounts to potentially obviously to what you paid for the loan when you net out your comp, but could even be substantially discounted to par. If you're selling a loan at 97 and you have this beautiful settlement that's coming 45 days from now, that doesn't really work. So obviously, versus the bullet point on top, the opposite is true. We want to, in that case, you do want to accelerate the cash exposure, because in this case, the cash is actually coming to you in a decline. So obviously your loan is out of the money, your trade is substantially in the money, and in that case the assignment is very valuable because you are bringing the value forward. So the current programs available right now, obviously, first and foremost is Wells Fargo. Just from a volume standpoint, the majority of our clients are approved and actively assigning trades to Wells Fargo. Citi has had a program for a long time that our clients use that is good. Freedom has just rolled out their program. They've had it for a long time, but we have worked with Freedom on kind of automating that into the MCTlive platform. North Point and the Money Source as well have programs as well. You can see two kind of groups that used to be on this list that are not currently on PennyMac and AmeriHome, but we do hear that they're looking at it at coming back in as the market settles out here. But this is the current list, and again, this is obviously valuable. AOTs are valuable in a market, in a volatile market, but they're valuable from an execution standpoint in general. And one of the reasons for this call is that the current dealer execution that exists out there has really accentuated the value of assigning trades right now. And we're not going to say that's going to continue into perpetuity, but there's no question that it's going to, it's going to be here as long as the volumes are here. So just again with bid tape AOTs, the savings are substantial, and I think that leveraging that, I think again, I just want to not to make Greg blush here on the phone, but definitely want to thank Greg for and Wells Fargo for kind of pioneering this execution. We think that look, it's my belief that there are more than one or two MCT clients that would probably not be in business today had bid tape AOT not been an option over the last few years. Especially in March and April when we had to assign some of that exposure. So that's definitely an essential ability. Obviously, AOT's been around for a long time, but the benefits of being able to get the execution that the data-driven bid tape allows you to take advantage of, while also having the AOT option, is pretty incredible. So again, we definitely see this as something that, although it's with the exposure issue that occurred in March and April, and there was some contraction in the availability of the program, we see this as something that will continue to dominate aggregator execution on the mandatory side into the future, and really, it's MCT's goal that eventually over 80% of commitments would have a trade somehow associated with it as we continue to move down this road.
Hey, real quick, Phil.
Yeah.
There's a couple questions out there, and I think Joe has one that he asked a little while ago, and I think it's a good time to hop in and answer that question from a delivery standpoint. Joe, the question is the new AOT product replicate more or less agency cash window delivery? I'd say the answer there is no. This is, kind of a best X ease of execution standpoint from the trade position. When the loan still gets to us, and I believe also the other aggregators that do these programs, it still goes through their normal process. So there's not an expedited review. There's not anything special in terms of the review process from an operations standpoint to make it as cash window agency delivery like, but it's more so just from the best X side of the equation. And one thing we're doing is a quick note. And a lot of clients realize, our turn times got a little out of control back in March, April. We've largely gotten that all taken care of and sorted out, but we're really watching volume. So we want to stay with a much tighter SLA on getting loans in the door and out the door, because we know speed of delivery, especially with all the forbearance stuff going on right now, is highly critical. But no, Joe, this doesn't kind of replace the delivery side of things. It's more so the upfront execution.
No, I appreciate that, Greg. Thank you for jumping there. Ian, if you can see, I apologize, I cannot actually see the questions real well here. Ian, are there any other questions that you can see?
Yeah, absolutely. We've had several come in. I'm happy to mediate those. One's easy that I can knock out. We have in fact recorded this webinar, and we will be distributing the recording as well as the slide deck in a follow-up email this afternoon. Let's see here. Here's one from John Ortega. For Phil, are we able to report on AOT bid tape savings on a per bid basis monthly, or basically he's asking about bid tape AOT reporting?
That's a great question. We're going to add more of that functionality in the near future here. Really what we want to it's definitely easy to send it from a trade standpoint. As far as how it affected your best execution. So the trade first answer is it's an easy ability to show what you have saved on the offer side. The analysis, I don't want to make it seem like this mutes the benefit of the AOT, but the analysis of actually what you saved on in aggregate will actually be a little bit less, because what's going to happen is the AOT is going to overtake your loan executions. So again, meaning that if you are saving 5 basis points, but there's another execution out there that does not allow you to AOT, and let's say it's 2 basis points better than what you would have had at the investor, let's say Wells Fargo, that allows you to AOT, your net savings is only going to be 3, but the savings from your trade is going to be 5, if that makes sense. So we do have the report right now that allows you to show what you've saved on the assignment. The actual report incorporating the best X differential on your loan sale side, that's still to come.
And obviously to note, in some cases when it's closed, yes, this adds advantage in the execution end. But if we're out, or any aggregators out 20, 30, 40 bips on any given loan, no, this is more than likely not making that up. It'd be an extremely crazy market if that's the case. But we kind of went into this thinking it's an ease of use for the client. Yes, there's some value there, so we'd like clients to put it into the best X. So when it tips it into our favor, we do win the loan. But we also realize that, yeah, there are times other factors at play that mean we may win by 10, or we may lose by 20, 30. It is what it is. But we know it's just one of the pieces in that ultimate loan sale decision. But it is a potential for some substantial savings if you're already selling wells or others' loans that have this available and you're not utilizing it. That's where the true savings then starts to come, and might as well grab that extra cash when it's available for you. And then one other note too, Ira has a quick question, and I think this is a good point as well. Yes, if you have a trade that's in the money, it's a good reminder, rather than just pairing out of a trade in the money with us, we allow you to substitute. So we know that, we're not writing checks like a dealer would if you're in the money on something, but we will apply that in the money value to a different loan that comes in the door. So certainly work on that commitment maintenance with the team to make sure you don't lose any of that market value if you have a loan that isn't going to make it through the process.
Sounds good. Any more questions for either Phil or Greg? Feel free to use the chat function and we'll see those pop right up.
That's awesome. No, I appreciate those questions, and Greg, thank you for seeing those questions. I didn't see those on my side. Yeah, Greg, I think again, if there's anything else you wanted to go over, I think that this like I said, this has definitely been a big innovation in in aggregate or execution, and we see it as continuing to move that direction. Greg, are you guys are, it sounds like still all in on the program in general throughout the volatility of the last few months?
Yes, definitely. Yeah, we never left. We didn't waver. We were very happy to still have our base AOT program as well. I know some others have exited that, and even though we didn't get a ton of business there, it definitely helped some clients through some challenging times a couple months ago. So we're still all in, and just thanks you guys, MCT, for inviting me, and also thank you all of our clients out there. We really appreciate the business and the long relationships we've had with everybody, and thank you.
Well, thank you, Greg, and yeah, thanks. Wanted to thank all the clients for jumping on the call, and Ian, I'll pass it back over to you to close this out.
Yeah, absolutely. Thanks everybody for joining us for another good webinar here. We're going to continue to provide these educational webinars on a more and more regular basis, so stay tuned. We've actually got several more that are going to be announced later this week. But in the meantime, reach out. You can reply directly to the follow-up emails or any email you get from MCT. You can also reach out to Phil, Justin, or Andrew, or call the office listed there on the slides. We're here to help you take advantage of bid tape AOT or any other strategies that may benefit you. So yeah, thanks a lot for coming, everybody, and we'll talk to you again soon.